You apply for an apartment lease, a car loan, or a basic credit card. The lender checks your file, sees a blank history, and denies the application. You cannot get credit without already having credit. That blank file costs you real money. Landlords demand higher security deposits. Auto lenders charge double-digit interest rates. Even car insurance premiums go up when the system cannot score your reliability. But the system has shifted. The market is now flooded with alternative data tools, rent reporters, and fintech cards, designed specifically to bypass that old loop. The primary danger for consumers today isn't being locked out. It is getting tricked into paying monthly fees for vanity scores or supposed score boosts that actual lenders completely ignore. To figure out what actually works, we have to break down the 4 modern categories of credit-building tools. We will map these categories directly to specific situations, whether you are an immigrant starting over, a student with no history, or a renter on a tight budget. Building a 700-plus score from zero does not require getting lucky with an approval anymore. It requires strategically stacking the exact tools that match your current cash flow. The oldest method is becoming an authorized user. This means a friend or relative adds you to their existing credit card account, bypassing the credit check entirely. The upside is immediate. You inherit that account's on-time payment history and its age, adding years of positive data to your blank file overnight. But you are tethered to their financial habits. If the primary account holder misses a payment or maxes out the card, that negative data goes straight onto your report and drags your score down with it. Before you join someone's account, you have to verify they consistently keep their credit utilization rate below 30%. Piggybacking is a powerful shortcut to establish a baseline. However, it requires absolute trust in the primary cardholder's ongoing financial discipline. Next, you can build a profile using money you are already spending. You pay rent and utilities every month, and you can leverage those payments without taking on a single dollar of new debt. Sometimes property managers handle this on the back end through systems like Access Rent. If they don't, you can use consumer apps like Pinata or Boom to report the payments yourself. The catch is bureau coverage. Free apps only send data to Experian and TransUnion, missing Equifax. Also, FICO 8 ignores standard utility data. Tools like Experian Boost bypass this by hardwiring your payments directly into the calculation so it counts. But keep in mind, if you leave a utility bill unpaid and it goes to collections, it will severely damage your credit file, whether you used a reporting service or not. Reporting your rent and utilities establishes a solid baseline, but mortgage and auto lenders want to see how you handle revolving debt, which these tools do not provide. That brings us to fintech's secured cards, like the Chime Credit Builder. These are hybrids. They spend exactly like a debit card, but report to the bureaus like a credit card. To use one, you transfer your own cash into a specific checking account. The amount you move over becomes your strict spending limit. This builds the revolving credit history lenders look for with zero credit check. And because you are spending money you already deposited, physical guardrails make overdrafting or carrying high-interest debt impossible. The trade-off is logistical. You have to tie up your personal liquidity to fund the card, and platforms usually require you to migrate your daily direct deposits over to their banking ecosystem. If you are willing to lock up some of your cash flow, fintech cards are the safest possible entry point into revolving credit. Finally, there are credit builder loans, offered by companies like Self. Instead of handing you cash up front, the lender locks a small installment loan into a certificate of deposit. This chart shows how an installment loan diversifies the 10% credit mix slice. You make fixed monthly payments over 24 months, accessing funds only when the term ends. But you pay an upfront fee and 15% interest to borrow your own money, and if you miss a payment, you are hit with late fees. Worse, that missed payment gets reported and actively destroys the very credit score you are paying to build. Builder loans are highly effective for algorithmic diversification. You must accept that you are paying a premium interest rate for a forced savings account. Let's look at the New American scenario. You are a working professional or a student with income, but you have zero U.S. credit history and only an ITIN, not a social security number. Your optimal move is the ITIN stack, applying for a Capital One Platinum secured card and pairing it with a self-builder loan. This approach ties up a few $100s in upfront deposits, but it bypasses the Social Security number requirement entirely, positioning you to hit a 670-plus score in 12 to 18 months. Now consider the budget-conscious renter. You pay your rent on time every month, but you do not have spare cash to lock up in security deposits or monthly app fees. You need the rent stack. Check if your landlord uses a free back-end tool like Access Rent. If they don't, manually sign up for Pinata to get free reporting to 2 of the major bureaus. Your systemic constraints dictate where you have to start. Matching your specific financial reality to these tools prevents you from wasting time on applications that will automatically reject you. If you are starting from absolute zero and want the highest possible score in the shortest amount of time, you are the ultimate optimizer. Your path is the optimization stack. This means simultaneously opening a Chime Credit Builder card for revolving credit and a self-account for installment credit. This flowchart shows why this combination is effective. It simultaneously feeds the algorithm, maximizing your 35% payment history while instantly satisfying the 10% credit mix requirement. But the logistical burden is heavy, managing 2 distinct apps, paying fees, and migrating direct deposits. Whichever stack you choose, the golden rule remains the same. Place every account on autopay and give the algorithm time to record your history. You never need to take on predatory, high-interest debt just to prove you are financially responsible. You simply need to align your existing cash flow with the exact tools designed to record it.